Ladies and gentlemen, I'd like to welcome you very cordially to today's conference on the company's results for Q1 2017. I'm fully abreast of the fact that these results on the top line are pleasing to you, whereas in terms of the results, they could disquiet you a little bit. So to the greatest extent possible, I'm going to tell you as much as possible about these results and tell you a little bit about the company's plans for the upcoming months, in order to dispel any possible doubts you may have about the company, its prospects, because they continue to be very good. On behalf of the management team, I'd like to welcome you to this meeting and this conference, and I'd go ahead and announce that I'm at your disposal. So, ladies and gentlemen, Q1, traditionally speaking, is a period in which sales take place after a strong November, a robust December. To the greatest extent possible, we try to utilize the winter collection and basically to sell it off to the greatest extent possible. We've done very well here. So the sell-off of the collection, the winter collection, and putting it into the warehouse was at a recordly good level. We were never so successful in selling our winter collection, so not much of that was put back into the central warehouse. So this means that in our stores, there's a lot of room, a lot of space for the spring collection, for our summer collection. This is something that's very good. It portends very well. So if this process, the logistics process in the stores, when run well in February and March, is quite important as a prelude to our spring and summer sales programs, and this is something that's happened, and so we've seen very good top line performance in March. So this is another quarter in a row in which we've recorded spectacular sales performance in footwear, and this is something that gives us a lot of benefit to our store sales. So we want to add another 13,000 square meters on a net basis to our floor space. I'll dwell on this in a moment. In 2017, we'd like to increase our floor space by more than 100,000 square meters. And so from today's point of view, I would say these objectives are not under any risk. If we look at the financials for Q1, we understand that we've not fully met your expectations and they're not in line with the consensus, but they're fully in line with what the management had expected. And these are the type of results we anticipated for Q1. Q1 is always a softer quarter for us. And so the higher the sales in this quarter, the better, or the higher the loss. And so if we look at the assumptions for the targets for the management program, this was put together in April. And so this does not disrupt our confidence in the full year results in terms of what's happened in Q1. And so we've gotten you accustomed to having good robust financial results in Q2 and Q4. I think this is something that will be repeated again this year. If we can see that April was a little softer for the industry, so it was a softer quarter, a worse quarter for us. And so we see there's quite a bit of traffic in our stores, so May will fill in the gap that we had in April. So May should deliver relatively good or very good performance. So we have the hope that these results will translate into ongoing share price growth. We show you this graph every time. Our company's been listed since 2004, and we've given the opportunity to our shareholders for the share price to grow. So from the very moment when we started, so we've generated more than 22,000%. So if we look at Q1, we can see that the company is coming close to 250 watts per share, which is a record-breaking result. And so the personal conviction of the management is that this is time where the company may see its shares trading in the upcoming period. Perhaps the results of Q1 don't really convince you of this faith, but if we look at the full year results, this is what we think is going to happen. If we look at the next slide, this is one we show you every single time to tell you that the CCC SA Group is not something that you compare to any other entity listed on our stock exchange. It would be very difficult to find a classic peer for our company. So we're the largest producer of footwear in Europe. So it's enough to say that companies that are positioned higher than we are have their production in the Far East to a greater extent than we do. So this is a type of promise of the quality of the footwear that we produce and the brand. And this, we also see that we have more and more brick and mortar stores offline, if you will. And we have some other brands like Adidas, Kappa, Puma. We've added e-commerce, and this is basically something that we treat with a lot of importance. We have some 500 brands, proprietary brands, but we also have third-party brands in our internet channel. So all of this brings and makes the CCC Group the largest footwear group in Central and Eastern Europe. We have a very high level of profitability and a lot of growth prospects as we look into the future. If we look at the operating structure and what's worthwhile to know about Q1 2017, as you can see, the number of stores on a net basis has grown. The store count has grown by 8 over the previous quarter. And I'll tell you a little bit more about the total number of openings and closures. So in Czech, Slovakia, and Austria, we had 2 stores added. In the other countries, we had 1 additional opening. If we look at some of the interesting openings, along with our franchisee, we opened a store in Ukraine, the 6th store in Ukraine outside of Western Ukraine in Kiev. And so this is a store that's been very profitable from the get-go. All of this contributes to constantly growing floor space in the CCC Group. So we have additional 13,000 square meters. So we have 12,000 new openings, and so 10,000 increases, and so 3,000 closures of stores. Those are in square meters. And so we closed 5,000 square meters. So in 2016, we closed 3,000. In 2017 Q1, most of the analysts are pleased by that because this shows that the management treats very proactively its store profile to ensure that we have a similar profitability. So we're looking at the profitability of our stores on a daily, weekly, monthly basis. We have campaigns that we follow to ensure that they're profitable. If they're not profitable, then we eliminate those stores. And so we've primarily eliminated small stores. So we had an 80 square meter store in Zakopane. This was an old store from the past in CCC. It no longer fits the current model. As you can see, we see that our international business accounts for more and more of our floor space. It represents more than 54% at present. And since we have a larger margin abroad, we can anticipate that in the midterm, our gross margin should trend up as well. If we now try to compose where we're opening and closing floor space, I think we should point out that the biggest close openings were in Poland. So we had some, and then we also had the biggest closures in Poland. So we had opened 3.2 thousand square meters. We closed for 2.7 in Poland. And so we also had some openings and closings, more closings in Czech Republic and Austria. And so we've been adding additional floor space. This is going according to plan. And in Q1, you don't see any additional floor space from Germany's closures. So this is something that calms us. So if we look at the store count, this graph or table will be in the attachments because we're reiterating some data here. But what can we read from this table? We can see that the average floor space is growing per store on all of our markets in terms of our cost efficiency and giving us the ability to add additional product range or assortment. What additionally is important in terms of the store count, the top three is Poland, Czech Republic, and Germany. Poland is something that pleases us greatly because once again, we're proving that there's a lot of potential, and we can look at the recent results, where we can see that the market share gain from 19.1 to 20.15%. And so we have a situation in which one CCC in Poland, in terms of its market share, has a market share like the next 9 sellers of footwear in the top 10. So CC's market share is something that we continue to expand, and giving consideration to the results in this quarter and beyond, we can see that's something that will continue to transpire this year. So if we look at the sales mix by product range, we also see some interesting phenomena. So we have bags and accessories in excess of 10% of top line, and these products offer the largest margins. So in the long term, this will generate some benefits to us. This also gives us an opportunity to utilize the greater amount of space we have in our floor space we have in our stores. That means we're going to have higher return on sales. On top of that, we're also very happy in terms of quality, because we see that the bags and accessories of Lasocki have performed very well, and so the demand is exceeding our expectations. We've been able to add some additional product ranges. We're going to have some stuff for children and school supplies in August. There's a lot of potential to continue improving our results. If we look at the sales mix for footwear, we have more for growing share of men's leather footwear, and we've been adding some more to our portfolio because of the store sizes. We see that the large powerhouses are interested in brands like Puma, Converse, so in New Balance and some of the stores in Poland. So we see that this is changing. And if we look at sales by region, there's no surprise here. Poland remains number one. We also see a growth rate of, well, the upsurge in sales is 60 million. All of our markets are growing. So we can see that e-commerce has shot up by some 50%. And so we can anticipate that this segment will become the number 2 segment in the very near future. What pleases us, looking back to September 2016, we see that the other markets are growing. We have Russia and Ukraine in this bucket, and I'll revisit those markets in a few moments. So you can see that sales on these markets are growing at a fast clip. If we look at sales per square meter, Poland is doing something that's nearly impossible. So we have like-for-like sales growth of nearly 8% from quarter on quarter, which means that the other countries, even though they're improving their sales per square meter, by 4% in Central Europe and 2% in Germany and Austria. They're not able to keep pace with the Polish market. On one hand, we're pleased with the return on sales and the growth in Poland. At the same time, we anticipate that this gap will begin to close and the level in other countries will start to move in the direction of the 100% we've seen here. Now, if we look at the like-for-like sales growth, there's been a lot of discussion. If we look at the weather and we consider what took place last year, so both November and December gave us a boost, especially if we look at the high base of January, February in the previous year. Some people had anticipated that there was going to be a difficult for January. We had anticipated that, and that in fact was the case in February. This situation started to improve radically. So if you look at the growth in percentage points for Poland alone, we have growth of 11 percentage points, and this situation continued in March. So at the end of Q1, we have 11% like-for-like sales figure. CE was 4.5% and 1.6% in Germany and Austria. Of course, we'd like to deliver more, but this was also a difficult period for the German market overall. So the 1.6% growth at the end of Q1 is a bit of information. If we look at the backdrop, it's something that is satisfactory. We're not showing this as a separate line item. If we look at the other countries, perhaps we'll change that in upcoming presentations. But Ukraine and Russia are reporting like-for-like sales growth, which is very robust double-digit figures. And this shows that the slow growth pace of expansion on those markets is sensible. If we look at our e-commerce activity, as we have mentioned recently, and the CEO discussed this fact as well, the company's ambition is to have two strong engines. It's brick and mortar business and it's e-commerce business. This is something that we're working on very strenuously. So we believe in the future of e-commerce. Of course, we're happy with the successes of today, but we don't want to wake up in the future and find out that we've slept through some sort of changes or transformations. That's why we made the decision to buy Eobuwie some years ago, and these figures show that this decision was the proper one. Over the last 5 years, we've seen constant growth in top-line sales, more or less growing by 100%. And so the EBITDA levels have trended up, and we've got satisfactory results. The same is true in Q1 of 2017, when our sales continued to grow quite rapidly over Q1 2016. Our EBITDA is keeping track. It's 1% lower as a result of marketing costs being up. And so we also have Eobuwie going on to new markets like in Lithuania and now Greece. So in this quarter, we'll have new markets, and expansion always means that we have higher marketing expenses. But this comes back to the company with very positive results. Now, if we take a look at this slide, on one hand, we can see that top line has shot up by nearly 35%. Gross profit on sales is 350 million compared to 269 million in the previous period. If you look at the gross margin, if your eyes are attracted to this figure, we've got a decline of 1.7 percentage points. Once again, this is the second time I had the opportunity to talk about this. that the bulk of these changes ensues from e-obuwie, the e-commerce expanding its top line. They have a much lower margin, so so it went to 15.4% from 8.4%. So if we look at the aggregate level, this could not have an impact on the gross margin. So what happens with our e-commerce arm in the foreign markets, international markets, will have a big impact on our gross margin. So if we look at selling expenses and general administration, this has grew up 31.2%. So this is growing at a slower pace than top line. EBIT is 16.1 million loss, and we have an EBIT of 3.5 million zlotys in the black. So this is below the consensus and softer performance than last year, but in line with management expectations. We had these type of readings internally when we were doing the planning for this quarter, and this is not any type of surprise to us. Where we were a little bit surprised, I would admit, this is the balance of revenues and financial expenses. According to the overall market, some banks, well, when they forecasted EU and euro and US dollar exchange rates, the predictions were different. And so the company had quite a bit of cash in. We have made certain loans in euros to the subsidiaries, and so we had an exchange rate of 4.32, and then at 31 March it was 4.22, so it's 4.5% lower. So there should be no surprise that we have a translation difference because of what happened with FX. This doesn't affect on the company's results, but it does have an impact in our P&L and in our balance sheet if we look at our valuation or measurements of these figures. So this loss, what depends what's going to happen with the dollar and the euro. So if those currencies appreciate, then this could generate a positive effect. But this is a position or a line item that we consider to be negligible. And so we have a net profit of 47.4 million in the negative. So in the red, so this loss is 1 million higher than what we anticipated, but it's quite close. We were surprised above all by finance expenses, finance costs. If we look at some of the positives we saw in this quarter on quarter, we saw that year-on-year basis, the movement in salaries or payroll was quite positive. Concentrating on the German market and the Austrian market, but above all the German market, we've got spectacular improvement in salary expenses measured by square meter for space. So there is potential in the salary line item, especially abroad. We concur with that, and we've started to look for that, starting with those markets which are of critical importance to our profitability, so Germany and Austria. And so we're optimizing cost there by some 20%, and this is something that's become visible. If now we look at the consolidated balance sheet, you can see there's growth in inventories. So 39% trended up. And so there's growth of 4 to 9% in one of the other areas. And so we had the large spring and summer collection. So it was partially in the stores on 31 March. And so we're also collecting FX funds to pay the advances for our autumn and winter collections. If we look at our long-term liabilities year on year, we have some growth. We explained this at the previous conference. This is a result of the measurement of the sales option held by 25% of the eobuwie e-commerce arm, where they have a put option, so we would have an obligation to buy that, and so that's some 20-30 million. So we also have some loans to finance our inventories, as well as advances for purchasing equipment, purchasing inventory. So if we look then at our cash flow statement, maybe I'll start with the bottom. You can see that at the end of the period, we've got 302 million in the cash, mostly in US dollars and in euros for payments for the autumn and winter collections. We've got negative cash flow on operating activity. That's because we've got more inventory, and this is financed by financing activity. So we have some more loans, and you can see this better on this bridge. So the company has drawn down loans for roughly 500 million in order to finance the operating activity. So we have more inventory for the spring and summer collections. Those are these two bars. And we had good euro and dollar exchange rates, and this is also for the autumn and the winter collections. If we look at the other components of our cash flow bridge, you can see that the purchase of property, plant, and equipment is quite small compared to last year, because we purchased eobuwie e-commerce arm. And if you look at our financing activity, you don't see those elements linked to the measurement or valuation of our loans for subsidiaries. This is something that's not done on a cash basis, and this is something that gives a return in the future. If we look at the debt ratios, we can see that our debt to equity has trended up because of our inventory purchases. So as we can see today, this is a one-off that will improve over time as the inventory is sold and the company will recover the cash through its top line sales. And we see that debt to EBITDA has fallen by 0.1 percentage points. And we can also see that the interest coverage is something that's improving from quarter to quarter. And so our strategy here for 2017, so it hasn't changed, and this is something that we emphasize. We're proud of the fact as a company that this strategy is something that we've been able to pursue with unwavering determination. We want to be the #1 player, not only in Poland, but everywhere in Central and Eastern Europe. We're waiting for the PMR ratings, which should be in the fall of this year for Central and Eastern Europe, and we're going to see whether or not we've been able to achieve this goal this year, or we're going to have to wait for a couple more months. But over time, we believe that this is something that in the next few months or quarters, we're going to be able to do this. It's not a matter of whether or not we would be able to do it. We're confident that we will be able to do it. The second important strategic objective is to improve our profitability in Austria and Germany. This is something that we continue to reiterate, but from quarter to quarter, especially in Germany, we've seen some deterioration. We've got a higher loss than in the previous quarter. This is a result of the fact that we've added 30, 40 odd stores which are ramping up, and they need 2 to 3 years to become mature stores, and much longer than in Poland. We had fewer openings in Austria, and we can see that there's greater concentration of stores in Vienna or Lower Austria. And we can see that our confidence in profitability being generated by Austrian and German markets is quite warranted. The next objective is to expand on the e-commerce capacity and capabilities of the overall group. We want to tap into the synergies between our e-commerce arm and CCCSA. We've got a joint design team that wants to add additional opportunities, and so we're utilizing the technological capacities. We're going to utilize the same technological platforms. We're copying them or mirroring them, and so we're exploring, as I've said, and we're building our skills and competences in terms of practicing our e-commerce as CCCSA, and this is something that we want to launch in 2018. So the schedule is not at jeopardy, and we're setting up new markets through eobuwie, our e-commerce arm. Another strategical objective financially is to improve our capital position, and so I want to walk you through this in detail. So we assume that we're going to have more long-term financing in our structure if we compare ourselves to other companies in the industry in Poland and elsewhere. So the long-term capital financing in CCC is not of sufficient magnitude. We want to change that. Somewhere in our minds, in our memory, we have memory of what happened in 2007 and 2008 when what happened with the banking system. We want to be less dependent on macroeconomic changes, what's happening in the banking market, and so we want to have more long-term financing. We want to have some convertible bonds, and we want to extend the opportunity for the management to raise the authorized capital. So if we look at the convertible bond issue, we want to have consent for this by the end of 2017. What we would like to do is for the magnitude of this issue to be around 100 million euros, and we want to have no more than 2 million shares issued, and so the issue price would be no lower than 300 zlotys per share. Well, we believe that money is available and inexpensive, and through convertible bonds we see products from 5 years ago in Europe and Africa, so some 22 billion euros. And so we think there's going to be quite a bit of convertible equity money out there. And we're not the only listed entity interested in that subject. So we believe that more and more people are interested in that, and that means we'll be able to utilize that here in the company and attract investors who are interested in convertible equities, and this could have a positive impact on the overall valuation of the company. We are counting on the extraordinary shareholder meeting to extend the period of authorized capital for another 3 years. We're going to reduce that from to 2 million shares without changing the program very much. So the issue price is at least 180 PLN, but no less than the average share price from the last 3 months. And so we believe that we're going to be able to optimize the capital position of the company, capital structure. So in Q1, we also set up another program with the supervisory board. We were working at the beginning of this quarter, and on the 8th of June, this will be presented to the shareholder meeting. This is a new management incentive program Well, we see and we know from within the company, we hear from you, that the previous management incentive program fulfilled its expectations and it delivered more than it was supposed to. And if we look at the results, the top line, net financial result, and the value of the company, we were able to, or the company was able to combine the interests of the company, the interests of the shareholders, and the interests of the key management members. And we believe that we're going to be able to do the same under the new management incentive program. We've put together an ambitious level of EBITDA. So 550 million in 2017, 650 million in 2018, and above 800 million in 2019. And we'd like to issue 1% shares or warrants in each one of these years. And we believe that the goals are ambitious, but at the same time achievable. And we believe that the management is highly committed to do this. There's a lot of team spirit here, and we believe that these objectives will be delivered. And the issue price would be 211.42 zlotys, which is the average price for 3 months, minus a 5% discount. And we believe that this is a price that's close to the market price. So we believe that this will have a positive impact or contribution to the financial results of the company. So if we look at our growth plans for 2017, you know them very well. We want to entrench them. So 100,000 square meters of new floor space. To a great extent, it's contracted. It's been calculated very well. We've got a bit of a safety buffer here as well. So we believe that we're going to be able to even exceed your expectations. So the bulk is here in Poland, 40% in Poland, and the rest abroad. So we have Hungary, Russia, Romania. These are wonderful markets for us. And so we intend to grow across all of the markets on a stable footing. If we look at the level of capital expenditures, natural, as we've mentioned, we've slowed down the expansion in Germany. We're looking at 4 stores, new stores there. We're looking at different options of development of growth in other markets. So 1 or 2 places will show up. This won't be a spectacular new number of stores, so we don't want to worry you about that or draw your attention. We'd like to tell you about this a little later once we'll inform you on the way, but we want to let you know that we have and we are looking at certain options in this respect in terms of new markets. If we look at the individual markets, we can see a total growth in floor space by 24%. We believe that this is something that will help us achieve the strategic objective, which is to grow top line by 28%. Austria and Germany are going to have a decelerated pace of expansion down to 15%. So in Central Europe, here we want to finalize one of our strategic objectives to be the top player. And then we look at Poland, the strength of the CCC brand and Lasocki brand in Poland are quite strong, and we assume and we're pleased with this growth. And so growing our market share by 2 percentage points is quite a bit. And this is not the last thing we have to say in terms of the shareholding structure. No major changes. The number of shares has grown by 37,000 from quarter to quarter. This is a result of the execution of converting warrants into shares. Several managers hadn't done that previously. So the major shareholder of the company in terms of shares and votes held continues to be Dariusz Miłek, who's the CEO and the founder of the company. And that means that we have confidence that there's commonality, shared objectives between the management and the shareholders. Ladies and gentlemen, that's more or less it from my side in terms of the results. We're fully abreast of the fact and we've been reading your messages and the communiques from the early morning hours. It's not the case that we're deaf to your ears. I understand you would want more for this out of this quarter. Well, in our opinion, this quarter is in line with our expectations. We don't have such sophisticated models, and perhaps this simple calculation led to such readings. If we look at the readings for the upcoming quarters, they're quite positive. So Q2 and Q4, I think you will be astonished in terms of what's happening in May. We can see that what's happening in May. And so what the best things are still on the horizon for the company, and they're starting to materialize. We've got a lot of wonderful expansion. We've seen great top-line growth, cost discipline. All of this taken together will transform at the end of the year. And so the management, the shareholders, the analysts will be pleased with the company's performance. So now I'd like to invite you to pose any questions you may have. If we won't have enough time to field your questions, then I would invite you to engage in some meetings. So we will be more available to you as of 2nd of May. We've got a new office here in Warsaw. We've always been open to you. It's the second part of the management team on the Piłsudski Square in the Metropolitan building. And so our doors are wide open to you as shareholders and analysts. If you'd like to talk with us and dispel any of your doubts, we invite you. We're a company that's transparent and open and is always available too. That would be it from my side. And so I'd invite you to pose any questions. I anticipate that you'll have a multitude of questions that you would like to ask me at this time. Does anybody have a question? Perhaps my presentation was so thorough that it's led to a situation in which, in fact, you have no questions. I thought that perhaps you would have a question, Michał. Of course, you'll get a microphone in just a moment. Michał Kozinski from JP Morgan. Let's start with the gross margin. What's happened in Q1 that the margin fell in Poland, where you had robust sales results? I personally had anticipated after Q4 sales in the beginning of this year that we wouldn't have to discount it to such a great extent as this year, and that the margins might even trend up. What might happen with the margin for the full year results? I remember the guidance from the previous conference when you had the improving international mix should give you a good offset for the e-commerce arm. Well, if we look at the floor space abroad, it needs some more time in order to mature. Naturally, we're making some adjustments to the plans in terms of gross margin. The best still awaits us, still in front of us. If we look at the difference of 1.7% in the gross margin, bulk of this is because of our e-commerce arm, but 0.6% we have to explain by other phenomenon. One of them is the negative like-for-like sales growth in January of this year. So January sales did not flesh out the way we anticipated, and with the same margins we had anticipated. We had assumed that we would have higher margins year on year. And so in February, we had to utilize slightly higher levels of reporting for a longer period of time. And since sales really got kicked off, we utilized that in order to reduce our stock levels to the greatest extent as possible. And so our winter stocks are at a record breaking level in terms of the small amount that went back into the warehouses, but everything else is more or less without change. One question about your operating expenses, about OPEX. You talked about a 20% decrease in salary expenses in Western Europe. What should we see here? Is this a result of optimizing headcount, or I don't want to talk about the possible magnitude of potential that we see. I've only been here for a few months. You might not believe me, but I think that in Germany and Austria, there's a lot of potential. and we believe that in the future they can be profitable in the long term. So we can see where we are and where the competition is. Well, this is something that will be continued, the 20%, 24% in Germany. This was some of the low-hanging fruit that we wanted to reach for. So we're going to have to do some optimizing of IT and logistics, but the company has designed them, and so we will do that. So we should anticipate ongoing improvement in our OPEX. And I think at the end of the day, I believe that we're going to be able to deliver a similar result to the one that we've been able to achieve thus far. Thank you. Since I have the microphone, could you say something specifically? What were you able to save on in Germany? What other things do you have in your targets, your sites right now? What was the low-hanging fruit? Well, above all, this is Germany. In Germany, there's a simple statement. Anything you can measure, you can improve. So we started to measure things, and we started to measure one store to another store. We looked at the deviations. We started to make the stores compete with one another. And the strange situations, we started to eradicate, improving things. There's a lot of potential in terms of work schedules. The work schedules weren't effectively aligned to the weekly schedule, the monthly schedule. This is where we were able to fill in some of our resources by some people who know about how to form schedules, work schedules the best. We brought in some people from some of the best international companies, and they saw things we hadn't seen up until now. So we compared the model in Poland, in Germany, and Austria, and the costs there are higher, several times, 3 times higher there than here. And that's the minus. The positive side of things is that there is something we can optimize. Does this change your expectations in terms of when you'll achieve the break-even point? Our expectations, which we try not to parameterize in time, assume that we'll optimize OPEX, including salary or payroll. Well, it's not just a matter of improving our return on sales, but we also have to improve our operating expenses, so salaries. What's the budgeted loss for Western Europe? As we pointed out, our objective is for the loss, the financial loss for Austria and Germany, even though we're opening more than 20 stores in Germany. We don't want the loss to be bigger this year than last year, and we want them to start reducing that loss. What was the loss last year? 75 million. Okay, thank you very much. So if you're gathering your thoughts to the next question, we'll ask some of the internet people to pose their questions. Is your e-commerce arm able to maintain this pace of growth up until the end of this year? After Q1, what we're seeing in Q2, well, it's not slowing down. E-commerce arm is opening up new markets. It's moving at a very fast clip. eobuwie is becoming more and more important to some of our suppliers. We now see that some that had to knock on the door are interested in our e-commerce company. So we believe that it will be, especially since international sales are growing. If I'm correct, we moved up from 34 to 49% is sales of shoes abroad. And so it's just a matter of adding more building blocks, so adding new countries. That's why sales are growing. And so you asked a moment ago about Germany. On a year-to-year basis in Q1 for Germany, the growth in sales is is bigger than 500%. So we can say that eobuwie has a rosy future. Is there an opportunity to realize the plans for store openings in 2018? Of course, this is a result of what the plan of openings, well, for floor space is and store count growth are not at jeopardy. So we've concentrated on countries and sites we had explored or had contracted. So we don't see any threats here or risks. We don't have any threats in terms of closures. Why has your stock, your inventory moved up so strongly? I think that question arose, well, when I talked about stocks or inventories. If we look at the mix and we decompose it, so it's grown in our central warehouse. If we look at our stores, well, we can say this mix has changed. We have smaller inventories in the stores. The stocks were sold off in the stores. And so we're using this central warehouse to deliver to the stores. In central warehouse, we have bigger stocks because we have a bigger purchasing of spring and winter collections because the group is larger than eobuwie. Well, we had 55 million in inventories previous year, and now as the scale of the business has grown, it's got 130 million in inventory, so it's an additional 90 million, and this is something that we should be pleased with because they have something to sell and they're going to be able to sell what they've got on stocks. What do the results look like compared to Q1 budget? So the financial result, the EBITDA, are more or less close to the expectations of the management. There was a difference of 1 million. Perhaps, are there some questions from here in the room? Welcome. Okay, you can hear me. I'm from Citibank. I wanted to make sure that I heard correctly. The gross margin fell in all the markets because you had some more aggressive sell-offs of your winter collections. Did I understand you correctly? And the second question, 49% in eobuwie, that's international sales. How much was there of international sales in Q1 of last year? What was the major reason for operating profitability in your e-commerce arm fell? Let me start with the second question. And let me check the figure in terms of the mix at eobuwie. If we look at its profitability, there's one fundamental element, namely its marketing. Marketing has grown by 5 million zlotys year on year. And that's as a result of opening up new markets. And at the same time, we want to utilize that moment in history where wherever eobuwie goes, penetrates new markets, it's been able to grow year on year by 150%. And we're doing this through marketing. That's the major line item. The second line item, shipping expenses and the distance to our new destinations are the two major drivers. So it's mostly marketing. And so it grew from 36 to 49% year on year if you look at the share of international business. And you said that you started to measure certain things. I understand. I expect that you're measuring. What's the profitability of eobuwie in Germany? It is profitable. Okay, it's profitable. And then if you compare it to the profitability in Poland last year, 2 years ago, if you're talking about eobuwie, if we look at the marketing costs and shipping costs and spread them and and look at the higher prices, I would say it's more or less comparable in between Poland and Germany. So we would say 19-20%. That's more or less. Are the marketing costs you're discussing, will they continue to take place in this up until the end of this year? And will they have an impact on eobuwie.'s profitability, say from last year? Well, this is a decision that the management board will make at eobuwie, and the management of the group, the management of eobuwie. These are decisions we'll make on an ongoing basis. If eobuwie is going to continue surfing on that wave, but I assume if things continue as they're going right now, we're going to continue to intensify our marketing budget and scale it up, because at the end of the day, this is something that's profitable. As long as I hold the microphone, I have one more question, and perhaps you could say something in a descriptive section. If you look at how eobuwie operates in Germany compared to Poland, is it the average price for a product is higher or lower than in Poland? And what are the costs of delivering products and taking returns from customers in Germany? Well, in descriptive terms. So without delving into the details from the alcoves, well, the price is no lower than in Poland. Shipping is higher. If we look at returns, well, German e-commerce, well, let's say in Poland, the returns are roughly 1/3, whereas in Germany, it's nearly 50%. eobuwie is quite effective. So the average for the e-commerce business and e-retail were better than the average for the retail market on all of the markets. And that's more or less the difference, okay, between our two markets. Okay, thank you very much. I'm from Raiffeisen. I've got two questions. My first one is that you mentioned 302 million. This is cash to buy autumn and winter collection for 2017. The costs in dollars for these collections are more or less similar to last year's costs. And the second question, if you look at the volume, will we see more or less the growth in purchases will be more or less in line with the floor space expansion? Well, both in terms of volume and in terms of value. This is pro rata growth to the revenue expansion. So if revenue should grow by 28%, well, then at least by that much, we have to buy more winter collections. Well, I say by at least that much because the sales of winter collection, well, we have very little leftover stock from autumn and winter, so perhaps we'll buy more. What about in prices? Well, giving consideration to the fact that our relations with international partners continue to improve, and looking at the positive movement in FX terms for local suppliers, plus we have factories producing solely for us, and so we take on the burden of warehousing what they produce for us. So we don't anticipate any major increase. We don't anticipate any price hikes for our inventory purchases. I don't want to be caught to this word, but are there any other questions that you'd like to pose at this time, ladies and gentlemen? If not, then I would like to thank you very warmly for your attention and for the questions that you posed. And I'd like to invite you to be in contact with us. And we're more than willing to share information with you we're available to you at all these times. So thank you very much. So I'd like to thank the people who watched us and listened to us in our TV channel. Okay, thank you very much.